I'm going to bore you to tears for about 10 minutes, then hopefully it'll get more exciting when my panelists will endure what I've got to say to you and to them, and then we can get the debate going. So this is really just to set the scene. As was introduced, there is a poll, which I think will appear somehow. Thank you. So if you take a crack at that on whichever device you're using or have to hand, that would be great, and we'll look at the results towards the end. You can cheat a bit and wait if you want, but I think people probably will figure that out as we move along. So in the next 10 minutes or so, what I'm going to try and do is to give you a sense of our firm's recent research covering the post-crisis performance of co-investments. As was said in the introductory remarks, then we're looking back over quite a long period, so a couple of crises that most of us in this room will remember, being the internet bubble and Lehman. The research covers that period and goes back a little further as well. Some of you who've been to Informer events over the years will recognize this. It's an update of what we presented last year, so bear with us if that's the case. And my usual sort of attribution to my colleague Kairat. We have a cracking researcher in our team who's not here, but he did all the work and I get to present it to you. So I'd just like to acknowledge his efforts here. So moving straight to what I'm going to go through today. A fairly sort of self-explanatory slide, I think. I'm just going to cover the methodology firstly, the sample data, the key characteristics of that sample data set, which has increased since last year, the research findings themselves, and then hopefully some conclusions that we can tease out. Apologies for this one, it's a bit busy, as we used to say, where I used to work for many years at GE Capital. Mutton first, I guess, is the phrase that springs to mind. One of the comments that we always make about co-investment, and I think those of you in this room will understand this, it's often under-researched with, I think, two notable exceptions, Josh Lerner and Tim Jenkinson, who we've cited at the bottom of the slide, if I can make the pointer work just there. So thanks to them for their efforts to remedy that research deficiency. They've done it as academics, we've done it as practitioners, just really crunching data that's available to us. You'll see in the bullet points towards the bottom here, I've tried to be quite precise about what is and what isn't a co-investment, so please bear that in mind. We exclude what we call companion funds, so funds that don't benefit from a second pair of eyes, as it were, from the co-investor. Oh, and one last comment before I go on. Don't feel the need to sort of take photos. I'll make the PDF of this presentation available at the end via the organizers. Abby, I think we can do that, can't we? She's thumbs up, perfect. So moving to the data set. Just maybe eyeball the bullet points as I go through the main points. The sample data is about 40 more than last year, so just shy of 500 co-investments as we've defined them on the earlier slide. 40 general partners in that data set. Global, as you'll see from the bullet point here. Quite a good proportion from Europe, and the rest US and North America more broadly, and ROW. A nice long history, 3 decades pretty much, and as I mentioned a moment or two ago, spanning several crisis periods. Moving to the next one. What I'm showing here really is the key characteristics or performance metrics of that sample. Those of you who are sort of, I don't know, Jackson Pollock fans or something, look at the splatters of red and black, left and right. Gross IRR on the left here, and MOIC gross again on the right. And then for the statisticians in the audience, we've summarized the distribution at the top here. So about 500 or so, just shy of samples. Okay, that's it for the feast of mutton. So let's kind of slice and dice that data set and maybe tease out the research findings quickly before we maybe discuss them as a panel. So firstly, I think probably one of the most important findings in private equity generally, and co-investment is no different. Co-investment returns are profoundly right skewed. You see that on the right of the slide here. So the histogram, shows that right skewing. You've got the natural movement in the middle. Those of you who've seen these slides before will note that this is mainly a buyout and growth capital universe. the distribution tends to be more concave than convex for venture. And I know Simon, one of our panelists, will comment on venture co-investment after I've finished here. That distribution mirrors the findings of other academic researchers, such as Tim Jenkinson, cited at the bottom there. And those of you who remember presentations I've given at similar conferences, informal conferences over the years, will be familiar with this slide. I have to say the skewness has decreased slightly this year. I don't know whether it's statistically significant, but it has come down a little bit year on year. So let's go to the performance of co-investment in sliced and diced in various different ways. Here we show gross IRR in pre- and post-crisis periods. The vertical lines show the interquartile range by year. And what I'd like you to do perhaps is focus for a moment or two on the two shaded regions of the slide here, the crisis periods, and looking at the performance post-crisis. So you see a suppression in returns here, increase in returns post-internet bubble, and a similar trend with Lehman, although probably not quite as marked, although some quite nice uplift more recently for these vintages. So similar trends post-internet bubble and post-GFC. I think the summary of that slide really is that co-investment performance is indeed somewhat pro-cyclical. That mirrors the findings of other researchers. So pacing is really important. Don't overweight in these areas if you can. Pace by vintage year as much as possible. Moving to the data sort of shown in a slightly different way. Here we show the median gross IRR, just for visual simplicity, versus the interquartile range that we saw earlier. Pre- and post-crisis, post-internet bubble here in red in the middle, and then the similar period post-GFC on the right. And so again, you see the two post-crisis periods showing quite a stark increase in performance. Internet bubble here, post-bubble performance there, GFC here, post-performance there. I've said this at other conferences over the years, but my greatest regret as a private equity investor is not doing more then. I don't know how many of you were brave enough to invest in 2009. If you were, well done. That would have been a good one. Looking now at the data in terms of MOIC, similar trends there. You can see the uplift here and here. I won't dwell too much on that slide in the interest of time because it mirrors the earlier one. What we've done here on this slide is to show how the performance of post-GFC investments in particular have performed. So here you see the median co-investment returns in pre- and post-crisis periods, gross IRR on the left here, and MOIC on the right. Important perhaps to note the uplift in MOIC, about 0.5 times after the internet bubble here, and then a similar, slightly increased 0.7 increase or so after the GFC. The IRR uplift, whilst stark, is lower post-GFC, and that's primarily as a result of the longer holding periods to secure value creation at that time. Last couple of slides. What I'd like to show now is how the top quartile returns have compare with buyout transactions more generally. So co-investments in red, buyout transactions, generally the entire universe that's available to us is there. So what we see here I think is quite interesting. We compare the pre- and post-crisis performance of co-investments in red with the performance of buyouts generally in black. And the metric we've used here is top quartile gross IRR. So what you see is post-crisis co-investments outperform post-crisis buyouts generally by a whopping 30% post-internet bubble. Wrong one. Here, and a similar increase in performance here, although not nearly as stark post-GFC. Another sort of slicing and dicing. Here we compare the pre- and post-crisis performance of co-investments, again in red, with the performance of buyouts generally. And here we use median gross IRR. The earlier slide was a quartile break. And again, using that measure, you'll see that post-crisis co-investments again outperform their buyout brethren. Similar levels of outperformance, albeit moderated by the top quartile to median scaling that you would expect. And lastly, before I sort of have a concluding slide, what I'd like to show here is the dispersion. I think dispersion is also important to investors. So here we show the interquartile range around the median. Same color coding, co-investments in red and buyouts generally in black. The hawk-eyed amongst you will note that the median gross IRRs here are the same as those of the slide presented a moment or two ago. The other thing here is that co-investments often, not always, but often show lower dispersion, and that's in the absence of what we call intelligent portfolio construction. If you adopt a co-investment portfolio construction with respect to a portfolio diversifying along 4 threads, vintage, manager, sector, and country, that dispersion is crimped quite considerably. So this is a sort of a naked dispersion rather than a crimped dispersion. So you would do better if you constructed a portfolio in the way that many people, including us, do. Most importantly, I think the conclusion here is that post-crisis co-investments have always outperformed post-crisis buyouts generally, and that's for each quartile. And you can see that lower, median, and upper. We expect that outperformance to persist. So last slide, sort of in summary, co-investment returns are profoundly right-skewed. No new news there. I think many of you will have seen similar research from the academics. They're generally less prone to pro-cyclicality. They outperform generally, and all the more so post-crisis, which I think, given the title of this session and the panel discussion that I hope we're about to have, that should give you food for thought. As I said, I think the conference presentation will be available earlier. Thanks to Kairat again for crunching the data. For those of you who don't know him, let's give him a bit of a plug. That's the fellow. And I think, Abby, can we now reveal the results of the survey before going into the panel? That would be great. There we go. So, well, we didn't have any not sures. That's terrific. So you're fairly emphatic in what you think. So better, worse, and similarly. Well, that's a nice sort of entree to the panel discussion. So let's do that. Thanks for listening. I'm going to ask my panelists to introduce themselves. So, Amanda, why don't we start with you? Go right or left to right from the perspective of the audience.
Thank you very much, David. Hi, everyone. My name is Amanda Tonsgaard, and I work at Triton Partners. I'm quite excited to be here and also slightly daunted. This is my first conference since Berlin, which is more than a year and a half ago, but I think a lot of you share that. Triton is a mid-market investment firm. We have private equity strategy, small cap, mid cap, and a credit strategy. We focus mainly on the Northern European markets. We like investments that are a bit complex, whether it's because of challenges in the investment or the structure, and that's kind of the niche we operate in. We have been doing co-investments since inception, but in all fairness, and I'm sure we'll get into this debate in a bit, it's something we're focusing a lot more on over the last, say, 2 years or so. And with that, I will hand it over to Simon.
Thanks, Amanda. I also was last at the Berlin conference where I caught COVID, and probably half the people I spoke to caught COVID, and we all brought it back here, which wasn't very helpful. I'm Simon Menashy. I'm a partner at MMC Ventures. We're an early stage venture fund, so we're down at the lowest end of the market from a co-investment perspective, and some would argue below the lowest end of the market. We manage about £650 million, primarily investing at Series A, so we go pretty early, and then we back our companies over a number of rounds. And we're investing particularly in very technology-driven businesses, a lot of deep tech and AI-type companies and companies building the next generation of digital infrastructure. So happy to talk a little bit about co-investment at our end of the market and how sometimes that blends with other types of deal structures and secondaries and so on.
My name is Enika Jorgoni. I was focused on growth equity and impact investments at CDC, the UK development finance institution, for the last 4.5 years. In the prior 8 years, I was an LP in CDC, and then prior to that, Capital Dynamics, so across markets, US, Europe, and emerging markets. At CDC, I've seen the direct investments that we did both as a sole direct investor, but also as a co-investor, and obviously with the LP hat on as well. And I can speak a little bit on emerging markets angle, as well as impact and ESG side.
And my name is Jean-François de Ruyet from Quilvest Capital Partners. I realize we need to refresh this picture. Quilvest is an institution investing in private equity and private equity only. We've been doing that over decades. We roughly manage $6+ billion, and the bulk of what we're doing is invest into funds as primary investors, as well as co-investments.
Jean-François, thanks. Thanks to my other panelists. Can you hear me okay? Yes. Okay. Some of you will have realized this is a bit of the Capital Dynamics Alumni Association, so forgive me for looking after my former colleagues, but it's nice that we've got the diversity here in terms of both gender and I think in terms of the approach and leaning that each of the investors have. I'm particularly pleased that we've got, quite unusually I think, in Simon, a venture co-investor. We don't see so many venture co-investors, so important to see themes there. Enika, I think, will give us the perspective of an emerging markets co-investor, which is, I think, sometimes a little bit different. Amanda will, I hope, give us the buyout investor, which is where we've spent most of our sort of professional activity together. And great, I think, to have a pure LP perspective in a way, or LP plus co-investor perspective apart from me, from Jean-François, so particularly pleased with the diverse nature of the panel we have. What I really wanted to do was just divide this into a couple of sections. Firstly, consideration of best practices. I think when we prep as a panel a week or so ago, the words and themes that came out were communication between the LP and the GP. The GP is lead investor. Responsiveness, I think being able to work in deal time. How many GPs in the room, if you'd raise your hand? Yeah, so you certainly will know the importance of working with a co-investor who can sort of basically keep up with the pace of a transaction. I think that's important. And then perhaps added value from the co-investor in certain areas. And I'll be particularly interested to hear from Enika and Amanda and Simon on that score as if you like, the GP representatives. And then probably more for Jean-François at the end, but not sort of negating comments from others. The juxtaposition, if you like, of fundraising with co-investment, something that many of us in this room, I think, are keen to understand better. So with that, if we can start with best practices, what I sort of really would like to hear, initially maybe from Amanda, is when does her firm Triton think is the optimal time to engage with a limited partner co-investor, and perhaps how agile can that limited partner be in terms of pacing, in terms of a willingness to assume exposure to broken deal costs if indeed it's an underwriting versus a syndication. So Amanda, with that sort of layup for you, perhaps you could comment on those things.
It's a very good question because I don't think there's a super simple answer to this. I wish there was. That would definitely make my life a lot easier. But I think one, it certainly depends on the circumstances of the transaction. And two, it is also to some extent individual investor by investor because they have different processes. But if we start on the big bucket, and don't worry, I'll try to keep it short, on the co-underwrite, I mean, that's obviously something where we would engage with investors much earlier because at the end of the day, part of the reason you're going to them is because you actually need the financing to make that transaction happen. And that we also see much more as a sort of partnership, depending on the construction. It can be, a partnership of equal minds where they would work very actively alongside us. Then you also have broader consortiums, but again, we want to bring investors in as early as possible so they take ownership and they really feel they're part of the process. We will take the lead for sure, but we need them to walk side by side with us and not like 7 steps behind. If we look at a syndication, that process is a lot more simple. We may have signed the deal. We may also even have closed it, depending on regulatory aspects. And time is a bit more generous, so to say. At least that's how we run things. So I think for us, it's to understand who plays on which specter, and what is their investment process. What does that look like? And as you go about, you get to know your investors better and better. You get a very good sense for this, and you can have very sort of quick, open, informal discussions.
Let me push you on broken deal expenses, Amanda.
I was trying to avoid that.
Make her work for a living. What's your firm's view to that when there's a real consortium established ahead of a bid or in the context of a process?
So let me put on my sort of investor relations hat representing all the investors, right? We have a fiduciary duty vis-a-vis the fund, the investors in the fund, to seek broken deal costs when it's possible. So yes, as a starting point, we would like a co-underwriter to take aboard costs. However, we also recognize that one, we would typically have been tracking a target for years. We may already have done quite a bit of work. And 3, in these days in particular, it can be a very competitive process. And the investors just don't have the same sort of budgets, risk appetite, and are not as close to the targets as we are. And you just have to show some flexibility as to when do you bring this up, by when do they actually start incurring costs.
So if I were to summarize, earlier is better and horses for courses. Would that be a...
I think that is very diplomatic said, yes.
Okay, well, there we go. Simon, let's look at it from the perspective of a venture. And what I was really interested to understand when we had our prep discussion, and by the way, we do almost no venture co-investing in our firm, and there's a reason for that, which I'll tell you about over a beer or something. But I was really interested to hear Simon's view of how he works with co-investors in the prep discussion we had. So Simon, if you could perhaps tease out, I think 2 or 3 of the points that we discussed as a group. The access to deal flow, point that you made, I think. The pricing of follow-on rounds in particular, where you're growing a company from A, Absolutely. In your case, B through maybe CD rounds using the Silicon Valley nomenclature. And then for the lawyer, how many lawyers do we have in the room? Or people who identify as lawyers? No, not too many.
No. We can talk more loosely then.
We had a rather dry discussion on suppression of preemption rights. So if that doesn't send you to sleep, nothing will after the lunch slot. So maybe if the audience is still awake, Simon, a bit on that as well.
Sure. Well, David, I mean, you're not unique in not co-investing in venture deals. And I think most people would look at a venture manager and say, well, that's a bit small for us. And of course, our portfolio companies become growth deals. And then they become eventually mid-market deals and pre-IPO rounds and so on. And so I think for us, it's about understanding from amongst the LPs that we already work with, and then perhaps those that we don't work with, but get interested as things go up the scale, who's got appetite for what and when. So there's very little co-investment really on our way into a deal at the beginning, because we're entering a company often at Series A, sometimes even earlier in making seed investments before they get to that Series A stage. And so, deal sizes start small. And we've got the benefit, therefore, of having always a pipeline of emerging winners from our funds that might become the next set of co-investment opportunities. And that creates, if we're doing our job well, the opportunity to keep in touch with our LPs over what might be quite a long period of time of gestation before the deals become ready for that kind of growth stage round. Now, the reality is that was all very well a few years ago, but today, of course, B rounds are happening sooner, they're getting bigger, they're more and more likely to be oversubscribed. They're more and more likely to be preempted, and that's happening at the C and D rounds often as well. And rounds are getting compressed down, and so the challenge often for us is we've got this great opportunity that we have preemption rights in a fast-growing company. If we've done our job well at Series A, we own a meaningful percentage of those pro rata rights, but we may have not reserved enough capital when designing our fund 3 or 4 years ago to meet to meet that opportunity at the B, and certainly not at the C and on. And so, we've been trying to figure out ways to bring LPs, potentially net new LPs to us into those deals. And so the difficulty being at our end of the market is that nobody really has a process. There's not kind of an established asset class of venture and venture growth secondaries or co-investments. And so we're having to all figure it out together. And back to what Amanda was saying, responsiveness and figuring the process out together in what might be a pretty compressed time period is quite important, where we might not be driving the transaction. It's probably helpfully being priced by another follow-on stage investor. But it's not clear exactly what we can commit to, at what point we have to make that commitment, a hard one rather than a soft one. And so we need to sort of juggle the process a little bit for how much co-investment we can bring along as the deal takes shape and heads towards completion, often before the terms are really clear. And so back to having a good line of communication, for us trying to give our LPs a little bit of advance warning, here's what's coming in the next quarter, but here's what's happening in the next 6 or 9 months. And there's these 6 opportunities and only 4 of them may coalesce, and they may not look exactly as we think they will.
So I think an interesting perspective there, in the sense that you're using the option that you have by way of preemption in later rounds to bring a co-investor to the table, which I think is interesting. Yeah.
Absolutely.
Enika, let's go to emerging markets for a second, and I want to sort of steer you a little, if I may. How is emerging markets co-investment different? Things like political, foreign exchange, expropriation, insurrection risks in the places where certainly you've been active over the years. Maybe adverse selection, that sort of old chestnut that we hear about from time to time. Is there a difference in the experience of the emerging markets co-investor versus what I presented a few moments ago? I think as a DFI, a development finance institution, is there something special that an organization like CDC can bring to the table in terms of adding value? I think a point that I made a moment or two ago. And then I think most importantly, perhaps, since it touches on other sessions and something that we're all hearing about, the sustainability and ESG angles in emerging markets co-investing, particularly when things like land repurposing and treatment of minorities are uppermost in people's minds. So if you can perhaps respond to some of those, probably not all of them in the time, that would be great.
Yeah, no, great. Thanks, David. So in terms of, I guess, some of the risks you mentioned from a market perspective, whether it's currency or political instability, which, even though we've seen in the last couple of years a little bit of political risk in even places like the US and the UK driving market uncertainty, but certainly more elevated in emerging markets. I guess those risks would be quite similar whether you're a direct investor, as a sole investor, or a co-investor. Obviously, similar to other strategies in co-investment, one of the things we would look for when we are following a GP would be whether they have expertise in that particular new market, if it's a new emerging market for them, and whether, as a co-investor, we can bring that know-how and know the market and have the connectivity and the value add, or whether that's a form, obviously, for the GP to de-risk their new investment into a large market. And in some instances, that might be okay, because maybe we as an institutional investor, or, we would bring that network and knowledge. And in some cases, obviously, it's not a risk we're willing to bridge. And then you touched on, a few other points on sort of ESG and specific risks in emerging markets, as well as government intervention. And we have certainly seen, some of those risks, perhaps not so much in appropriation in the markets that, I've been active, But certainly we have seen government intervention when it comes to regulating profits, particularly in highly regulated industries like financial services, which is where I was active investing, where we've seen essentially regulators regulating away, some of the margins, essentially, which make it quite difficult for investors and for the flow of capital to be regular. And this is where DFIs, certainly while they can't always really influence to that extent the regulator, but can bring a little bit of the long history as well as the connectivity and influence and the long history of investing to give their co-investors, some of the comfort as well as some of the frank, acknowledgement of the risks as well.
Mm-hmm. So before we go to Jean-François and talk about the juxtaposition of co-investment with fundraising, I want to put each of you on the spot. I'm going to give you a moment or two to pause, Enika. But if we go back to the subtitle of this sort of part of the session, best practices, could I ask each of you to highlight 2 best practices from the perspective of buyout, venture, and emerging markets co-investing? Amanda, you first.
Mm-hmm. From my perspective, from the GP perspective, what's best practice for us?
Correct, yeah.
In how we act or how I'd like the LP to act?
Deliberately ambiguous.
Right, okay. I think for us, best practice when we engage with an investor is really that they come back to us quite quickly. It doesn't have to be a firm. We understand, of course, they need to do their work. But the way we operate is we ask an investor, and if they decline, we go kind of down the list. We don't go out and ask 5 investors, have them do all the work, and then we scale them down. So that just means the process for us can take a while. So the faster investors come back, the more transparent they are with why they're declining. So next time I can be more spot on with what we potentially offer them. That means a lot for us.
And another one?
Oh, I thought it was could count it too.
It's all right. No, that's fine. You can count those as 2.
No, but I think really transparency on the investment process on their side, particularly when it comes to co-underwrite. Right. Because in some instances, they have very good visibility because they have check-in points throughout the process. In others, you have a deal team working on it, and then, in the very 11th hour, you have an IC who's a lot more remote. And it's very important for us to understand what are the potential risks, because as I mentioned earlier, in a co-underwrite, you actually need the money the day you're going to sign. So that are 2 very important points for us, I would say.
Simon, your turn, briefly if you would, because I want to give Jean-François
I'll be brief. I think mine is kind of the same for GPs and for LPs, which is being clear with each other about what the full scope of the process looks like and who needs to be involved from which teams, which often at venture can mean there's a co-investment person and there's a venture person and then there's someone on the west coast of America who kind of knows that kind of bit of the tech world, who wants to, who has a strong opinion on something. And also be clear on what access to management is or isn't on offer and required for that investment, because we've seen these sort of drift a little bit, or we've gone past the first process, but actually we'd quite like to do some reference calls here, and we'd quite like to spend a bit more time with management there, and before you know it, not only has the scope of the process exceeded what everyone expected, but also you may be past the point where you kind of needed to indicate yes or no, we're in, we're not in order to access those co-investment rights in the first place.
Enika?
I would say speed and clarity as the first, and then the second, I now combine 2, and then the second value add. And I guess in speed and clarity, a lot of it, for CDC, for example, was also changing a bit the investment process for some types of co-investment in order to facilitate a faster, process and also empower the deal teams to make some of the decisions rather than going, to some of the more formal processes for the initial terms, for example. And then clarity comes into, both kind of clearly setting out if a deal is a fit or not a fit, but also in clarity of the role as a co-investor that we would play. So whether that would be, demanding data and active involvement on a board seat, whether that would be, really adding value from an operational standpoint or a technical standpoint. Sometimes that would be ESG, sometimes that would be market know-how and knowledge. So really just being clear on sort of the value that we would bring. And then I guess the value added ties into that. So it's essentially being quite open about what we can and cannot do, because ultimately a lot of your reputation and ability to get co-investments in the future and be a preferred partner will depend on keeping those promises as well.
So, yeah, perhaps unique to CDC as a DFI in some of the value add aspects that you've mentioned.
Yeah.
Okay. Jean-François, juxtaposition of fundraising and co-investment. What can the LP do to maximize the benefit of co-investment from your perspective?
Well, I think during the fundraising process, I think it's important that an LP mentions very clearly, it's very often the case, by the way, very clearly what they want to do, what they don't want to do in terms of co-invest. I think you would agree that in the IR department, it's very important to know exactly what kind of LP you're going to be, or if it's a re-up, you are, and what kind of appetite you have in terms of co-invest. And that helps you get more qualified deal flow in terms of co-investments. So I think it's important to mention that very early in the process and rather than later. The other thing that we are seeing today is sometimes some larger LPs trying to sort of preempt in advance during the course of the investment period of the fund the co-investments. And that's something, maybe because we're not that big, we don't like. And I think a lot of investors, a lot of LPs don't like to see, at the end of the day, too much formality, too much predetermined allocations and things like that for LPs. We prefer less is more, and we prefer that it is completely at the upper end of the GP to decide, again, over the course of the investment period, to whom they're going to offer co-investment. We don't like formulaic pre-arrangements during the fundraising process. We really think that it's very important for the GP to be able to decide who's going to be the best co-investor on a deal-by-deal situation.
So fight your corner, if I can summarize, and flexibility. From what
totally.
You said.
Yeah. Again, as I said, the less we see about co-invest in side letters or in the LPA, the better it is for us. We don't really believe in all these kinds of arrangements. And if we see too many arrangements, to some extent, it shows to us that the GP is a bit weaker, because the GP has to yield to some of the LP's demands. I don't know if you would agree, but that's at least the way we tend to see that.
And how do you, in the fundraising debate, how do you see co-investment affecting the relationship between the general partner and the limited partner?
During the fundraising,
yeah.
I think for us the discussion is very important to see what kind of co-investments they're going to offer, how they're going to organize the process. And what we do in our due diligence is we look at the past. I don't know if that's also part of your question, but we look at the past co-investments. Mm. What was the process? Who are the co-investors? Why did these guys get co-investments rather than others? So all these things are actually quite important for us, but more on a soft aspect as opposed to something written black and white.
Yeah, okay. So again, flexibility.
Totally, yeah, flexibility. And top of funds and all these things we don't like, to be honest, because we like, again, I'm going to repeat myself probably, but we like the GP to be able to really decide who's the best co-investor or who are the best co-investors for each particular transaction.
Yeah, and we, by the way, wearing an LP hat would have a similar view. I'm conscious of the fact that other than the poll, we've not engaged with you, so Abby, do we have a moment or two for questions? We do. Okay, a roving microphone sort of with Abby. Please, if you have any questions for me or the panel members, please raise your hand.
When you do ask a question, please state your name.
Oh, very shy. Well, if not, we're available to be rugby tackled, at least most of us, afterwards. And I think we're trying to keep you on time.